The silver market just wiped out 40% of its value in less than 2 weeks. If you're watching this right now, you're either panicking about your losses or you're wondering if this is the buying opportunity of the decade. Because here's what nobody's talking about. While silver crashed from $121 to $78, 3 major investment banks just released completely contradictory forecasts. One says it's going back to $100 next month. Another says it'll hit $150. And the third? They're telling clients to expect $65 by year's end. So who's right? More importantly, what should you do with your money right now? Let me show you something that'll make your stomach drop. On January 29th, 2026, silver hit an all-time record of $121 per ounce. Investors were celebrating. The headlines were screaming about the new silver bull market. Fast forward just 9 days, and that celebration turned into absolute carnage. The price didn't just decline. It collapsed with a velocity we haven't witnessed since 1980. That's 46 years of market history. And we just saw volatility levels that matched the Hunt Brothers crisis. If you don't know what that was, the Hunt brothers tried to corner the entire silver market, and it ended in one of the most spectacular financial implosions in American history. But here's where it gets interesting. While everyone's focused on the crash, they're missing the real story. Silver is currently trading around $78 to $79 per ounce as of today, February 8th, 2026. That means it's stabilizing. It's finding a floor. And the smart money, the institutional players who move billions of dollars, they're not running away. They're recalculating. They're repositioning. And some of them are getting ready to buy aggressively. So what actually caused this massacre? Because if you don't understand what happened, you can't predict what happens next. The catalyst wasn't some random market event. It was a political appointment that sent shockwaves through the entire precious metals market. Kevin Warsh got nominated as the new Federal Reserve Chairman. Now, if that name doesn't mean anything to you, let me break down why this matters. Warsh is known for having extremely strong views against a large Federal Reserve balance sheet. Translation, he wants to tighten monetary policy, he wants a stronger dollar. And when the dollar gets stronger, precious metals typically get crushed because they're priced in dollars. The moment his nomination was announced, algorithms started selling. High-frequency trading systems dumped positions in milliseconds. But that was just the beginning. See, the silver market had become incredibly overleveraged. Speculators had piled in with massive positions using borrowed money, and the exchanges knew it. So they did what they always do when things get too hot. They raised margin requirements. That means if you wanted to hold your silver position, you suddenly needed to put up significantly more cash as collateral. Here's what happens next, and this is critical to understanding the cascade. A trader who was holding $1 million worth of silver contracts suddenly got a margin call. They needed to deposit another $200,000 immediately, or their position would be automatically liquidated. Multiply that by thousands of traders, all getting margin calls at the same time, all being forced to sell. It creates a feedback loop. Prices drop, which triggers more margin calls, which forces more selling, which drops prices further. It's a liquidation death spiral, and silver's market structure made it exponentially worse than what happened to gold. And that brings us to a crucial point that most people completely misunderstand. Silver is not just a bigger, more volatile version of gold. It's a fundamentally different animal. Gold is primarily an investment and store of value. Central banks buy it. Wealthy individuals hoard it. But silver? Over 50% of silver demand comes from industrial applications. We're talking solar panels, electronics, electric vehicle components, and increasingly artificial intelligence infrastructure. Every data center, every server farm, every AI chip uses silver. The explosion in AI development isn't just theoretical for silver, it's creating real physical demand that has to be met with actual metal. But here's the problem. The silver market is tiny compared to other commodities. The entire global silver market is a fraction of the size of gold, let alone oil or copper. That small market size, combined with thin liquidity, means that when big money moves in or out, the price doesn't just shift. It explodes in one direction or the other. During the crash, there simply weren't enough buyers to absorb the selling pressure. The bid-ask spreads widened to levels that would be considered a crisis in any other market. Some dealers stopped quoting prices entirely because they couldn't keep up with the volatility. Now let's talk about what the banks are saying, because this is where it gets absolutely fascinating. UBS, one of the largest wealth management firms in the world, just released a forecast that has silver returning to the $100 threshold by next month, March 2026. That's less than 4 weeks away. They're predicting a sharp bounce back, though they expect it to fall to around $85 by year's end. So they're bullish short-term but cautious for the full year. Then you've got Citigroup analysts who are throwing around numbers that sound almost crazy, $150 per ounce. They're basing this on physical market tightness and broader concerns about currency debasement. Their argument is simple. The supply deficit isn't going away. Industrial demand keeps growing. And if faith in fiat currencies continues to erode, silver becomes one of the go-to alternatives. But wait, because Bank of America just raised their 2026 outlook to $65 per ounce, with an average forecast of 56 and a quarter. That's significantly lower than where we are right now. So Bank of America is essentially saying this current price level is too high, and we should expect further downside. 3 major banks, 3 completely different forecasts. How is that possible? Because they're weighing different factors differently. UBS is focused on the technical rebound and short-term supply and demand dynamics. Citigroup is taking a longer-term view on monetary policy and structural deficits. Bank of America is being more conservative, factoring in potential demand destruction at elevated prices and the risk of further Fed tightening under new leadership. So what does the technical picture actually tell us? Right now, silver has established support in the $69 to $70 range. That's where buyers have been stepping in consistently. On the upside, there's resistance in the $82 to $84 range. We're currently right in the middle of that range, which means the market is in consolidation mode. It's taking a breath after the insanity of the past 2 weeks. The algorithms are predicting a modest increase of about 2.5% over the next 7 days, putting silver around 79 to 77 by February 13th. But here's what you really need to know about what happens next. 3 scenarios are playing out, and understanding them will determine whether you should buy, sell, or wait. Scenario 1, the bull case. Silver bounces aggressively in the next 4 to 6 weeks, retesting the $90 to $100 level. This happens if the physical supply shortage becomes undeniable, if industrial demand data comes in stronger than expected, or if there's any geopolitical shock that drives safe haven demand. The structural supply deficit is real. Silver has been in a deficit, meaning demand exceeds production for multiple consecutive years. At some point, that deficit has to express itself in price. Scenario 2, the consolidation case. Silver trades in a range between $70 and $85 for the next several months. The volatility calms down. Speculative interest fades. The market becomes boring again as it digests the move and waits for the next catalyst. This is actually what a lot of professional traders expect. Markets don't go straight up or straight down forever. After extreme moves, you typically get extended consolidation periods. Scenario 3, the bear case. Silver retests the lows and potentially breaks down to the $60 to $65 range. This happens if the new Fed chairman implements aggressively hawkish policies faster than expected, if the dollar strengthens significantly, or if industrial demand softens due to economic slowdown. At elevated prices, some industrial users might look for substitutes or reduce consumption. Solar panel manufacturers, electronics companies, they all have price sensitivity. Now, here's the critical question. What should you actually do? If you're thinking about buying right now, you need to understand your risk tolerance and time horizon. This is not a market for traders who panic at 5 or 10% moves. We just saw a 40% decline in 9 days. That level of volatility will absolutely happen again. If you can't stomach watching your investment drop 20 or 30% in a week, silver is not for you right now. But if you're a long-term investor who believes in the structural supply deficit story, who thinks industrial demand will continue growing, and who wants exposure to a hard asset that's not correlated with stocks and bonds, then this pullback might represent an opportunity. The key is not to go all in at once. Scale into the position. Buy some now, keep cash ready to buy more if it drops to 70 or 65. That way, you're not trying to time the perfect bottom, which is impossible anyway. If you're already holding silver and you're down significantly from the top, the decision is tougher. Selling now locks in your losses, but holding means potentially enduring more volatility. You have to ask yourself, has the fundamental thesis changed? If you bought silver because of the supply deficit and industrial demand story, those factors haven't disappeared. The price crashed because of forced liquidation and leverage unwinding, not because the fundamentals deteriorated. There's also a major liquidity event coming that nobody's talking about. The Chinese Lunar New Year runs from February 16th through the 23rd. That's next week. During this period, Chinese markets close, and China is the world's largest silver consumer. Liquidity will dry up even further. We could see exaggerated price moves in either direction simply because there aren't enough market participants. Smart traders are positioning ahead of this, either hedging their exposure or preparing to take advantage of any panic moves. The one certain thing is that silver remains in a structural bull market despite this violent correction. The supply deficit isn't going away. New silver mine production isn't ramping up fast enough to meet demand. Existing mines are depleting, and the industrial applications keep multiplying. Electric vehicles use significantly more silver than traditional cars. The solar industry's growth trajectory requires massive amounts of silver, and we're just at the beginning of the artificial intelligence infrastructure build-out. But timing matters. Just because the long-term story is bullish doesn't mean the short-term path is straight up. The market needs to clear out the weak hands, the overleveraged speculators, and the momentum chasers before it can build a sustainable base for the next leg higher. That process could take weeks or months. So here's the bottom line. Silver at $78 is down 40% from its peak, but it's still up dramatically from where it was trading a year ago. The crash was brutal, but it was driven by technical factors and forced liquidation, not fundamental deterioration. 3 major banks have wildly different forecasts because there are legitimate arguments for multiple scenarios. The market faces significant headwinds from potential Fed tightening and a stronger dollar, but also substantial tailwinds from supply deficits and industrial demand growth. What happens next depends on which force dominates over the coming weeks and months. Position size matters more than entry price. Don't bet money you can't afford to lose. And remember, in volatile markets, the people who survive are the ones who can stay solvent long enough to be proven right.